Hi, everyone, and my name is Simon Ring. I firstly just like to thank our friends at GTR for hosting this session today, which is on a very important topic of sustainability and all things ESG. In today's session, we're going to be looking and talking a little bit about all of those matters, obviously in the follow-up from COP26, the IPCC report that's been happening. I think you probably need to live on the moon not to be seeing this in the media. But essentially, for today's session, I'm going to be joined by Hannah Vanson from the LMA and Philip Lillefelt from Vasander, which is a part of the Polestar group of companies. We're going to be talking and focusing on, as I've mentioned, the sustainability and focusing really on the kind of commodity and trade and supply chain sectors in that regard. As a company, as a technology company, we work extensively in the kind of commodities and the financing of global trade and supply chains. And over the last year or 18 months, we've been working collectively in collaboration with certain other companies, looking at building single service solutions that can look at all of these processes that people are going to start to need and require. And I think just to outline, obviously the focus for today in terms of the sectors, I guess the primary driver and reason we're looking at the commodities end-to-end and supply chain elements are that, I mean, depending on what statistics you read, greenhouse gas emissions, carbon emissions are estimated to be produced at somewhere between 50 and 70%, depending on what stats you read from the commodity sector. And obviously the lifeblood of commodities in terms of moving 90% of world trade is shipping. And again, if shipping was ranked as a country in terms of carbon emissions, it would rank number 6 in the world. So no surprises that obviously there was a great focus on this at COP26 and following the IPCC reports. If anyone watched COP26, I will excuse myself now, if you'll forgive me if I don't remember all of the abbreviations that were used. There were far too many to even think about. Alphabet soup, I think it was called. But in essence, I think one of the things we're hearing and seeing and talking to our customer base about right now is the transition that we're seeing to disclosure on all matters sustainability. And I think obviously what we're starting to see already is here in the UK, I think the first of the G20 countries that will need to report in line with the sort of task force for climate related disclosure. There I got one right, in as close as April of next year, 2022. And I think one of the other big takeaways that we saw from COP26 was the implementation of the ISSB, the standards board for, again, disclosure in these areas, which is set to hit the industry by Q3 of 2022. So for many of our major clients, that doesn't give a great deal of time to transition across and work these programs and processes through. But it's coming very quickly. And obviously, following COP26, I think there's going to be an ever increasing focus in these areas. In terms of the actual trade and trade financing markets, I mentioned earlier that as a company, we've been working in supply chains for several years now in terms of sanctions and compliance. And many of our customers have talked to us about single service solutions, the ability to look end to end at processes and transactions as we enter this new era. And from our part, we've looked at using essentially our Purple Track solutions, which are embedded and used by many major banks that finance commodities and many of the major traders around the world as if you like, a baseline to start from. Most of our clients talk to us about the fact that they expect 70% of their carbon emissions to relate to shipping outside of mining, extraction, and agriculture. And obviously, the increase that we're expected to see in ocean-going cargo volumes, they're set to grow by about 130% by 2050, that magical date that everyone's looking for net zero. So the implications on the financial sector are much wider than commodities, of course. This will have an impact in any form of investment, pension funds, fixed income, many areas of the financial sectors. But we've been working quite heavily for the last 18 months with our partners at Carbon Chain and Vasander, trying to build out essentially a single service solution that can look at transactions on a pre-transactional basis or a post-transactional basis, where we can get essentially from one end of a transaction to the other and report on the carbon and greenhouse gas emissions in that particular transaction. This is obviously something, again, in supply chains that we expect to see coming in various different formats, from the shipping companies themselves to ports, to flag administrations, to insurance. So the cause and impact will be much wider than the commodity and trade financing sectors. But we think that's probably where the focus is. We had a lot of talk about deforestation, coal, and so on and so forth. And obviously those are the areas that people seem to be very focused on currently with us right now. So I'm going to hand over to Hannah to introduce herself and talk to about some of the regulatory issues. Hannah, over to you.
Thanks, Simon. So my name is Hannah Vanstone. I'm a legal associate at the LMA, and I'm currently heading up our ESG and real estate finance initiatives. And so what we've been seeing really is a wave of interest around ESG amongst regulators, following really the direction of travel that we've seen in the wider market. And in particular in the EU, we've seen a lot of regulation coming through looking at environmental risk and climate change. So we've seen the taxonomy regulation come through, which is looking at classifying those activities which can be considered as sustainable, and so in that context looking at potentially channeling capital towards those types of sustainable activities. And we've also started to see more regulation coming through around ESG disclosures generally, and there was a lot of announcements around that at COP26. So that's an area where I think we'll see increasingly not just voluntary market standards such as the TCFD reporting framework, but also regulators stepping in to say what types of disclosures companies need to make. And then for investors, there's this sort of regulation around disclosures in relation to investments as well, and how those are aligned to broader ESG objectives. So there's a lot of focus on ESG. So far, as I say, it's been quite focused around the E in ESG, environmental side, but I think there is more discussion around social as well. So I think that's something that we're starting to see come through in terms of the language from policymakers. And so there's that increasing focus on not just alleviating and meeting climate change objectives, but also on broader social issues and how these issues can be tackled as well.
Hannah, thank you. I'd like to introduce Philip Lillifeth, the CEO of Vasander, technology company focusing on the social and supply chain solutions in the commodity sectors. So Phil, I mean, obviously we've seen quite a lot come out of COP26, but the big takeaway, I guess, from your perspective must be around the fact that while Singapore and Asia have certain programs and that they're looking at now around all of the above in terms of the ES and the G, surely the ISBB, the formation of the standards board and the support it has globally is going to start to see these disclosure requirements right around the world rather than just in the EU or in the UK to start with.
Thank you, Simon. Yes, in terms of the global disclosures, I think we are finally seeing some consensus and some frameworks being drafted now to give us a little bit of a direction in terms of what's required globally to report on sustainability as a whole. Of course, there is a lot of news flow at the moment, and as rightly Hannah pointed out, it's very much E-centric at the moment, but also just to go into that, it's the tunnel vision seems to be focused on carbon as well. So I think what's really interesting is that if we look at the IFRS and what they are trying to do by combining the SASB framework and the CDP, is that really to extend this disclosure, the disclosure topics, to cover an array of different disclosure topics across the E, the S, and parts of the G. Now, depending, of course, on how your organization works or the type of sector you're in, of course, there will be some slight nuances in terms of what emphasis you would put on which letter. However, I think what's really interesting about the ISSB and the formation of the ISSB is setting a global standard that will hopefully be recognized globally. And we've seen the TCFDs and SFDRs being adopted in parts of Asia, like Singapore and Hong Kong, and also it is something that is being adopted here in the UK. And soon in Switzerland as well. So it would be interesting to see some of these topics being discussed a bit more broadly. I know that a lot of the news that came out of COP26 has been around ending deforestation by 2030 and the net zero targets, of which different countries had different sort of objectives, and the allocation of capital and who needs what and when. But in terms of the commercial world and global trade, I think that's what's really important, is to look at what bodies are going to require and mandate what type of reporting. And essentially, this is what we are trying to do here at Vasanda, really, is to make sure that we are not just an ESG analytics firm, where we an ESG data, an analytics reporting tool that allows you to be aligned with all of, as you rightly called it earlier, the alphabet soup, all of the regulations and the various different bodies and disclosure topics that are required to provide a more comprehensive reporting standards. So I think what would be interesting to see happen also is the commitment from countries and the influence that will have on the corporates that are operating with those sort of jurisdictions about certain topics like the carbon emissions and the net zero commitments, and also to see things like the pact around coal and the decommissioning of coal out of our fossil fuel usage, etc., reduction of fossil fuel and introduction of renewables. I know I was reading recently about the airlines are going to be under pressure to use sustainable fuels or SAF, but we are very long way ahead of this. And I think, we need to tread carefully as well, because we shouldn't really be focusing on being punitive to corporations, because post COP26 is going to be a lot of sort of soaking up of the information and the output from the white papers that will come out and the direction that we are required to go in. So it's understanding what we need to produce, when we need to produce it, and what our responsibilities are going to look like. But again, going back to whether investors should be investing in purely green or specifically towards putting capital in things that have been disclosed as green. I think that's really not the right approach. I think the right approach would be is to work with organizations who we think, okay, can reduce their fossil fuel, are well capitalized, and can mobilize some of that capital to become more renewable, to become a bit more green, or even support projects, ancillary projects, and various engagements they have globally to become a better organization. So I think rather than become a, sort of create a framework of punishment for a lot of corporations, and a lot of corporations out there who have a bad reputation for not being green. But what's important is that they are well capitalized, large organizations that have staff and a large labor force. So there is also the responsibility of making sure that these companies don't actually become overnight the pariah, so that we can support them, invest in them to become more greener and actually lead industries.
I mean, coming on to the kind of technology side of this, this is a very complex area in terms of end-to-end solutions. And I guess coining a phrase from our good friends at Carbon Chain, our collaboration partners, Adam Hearn, what gets measured gets managed. And I think fundamentally now, as we enter into this transition, the available technologies that can help and support institutions and industry report and monitor in these areas is becoming more and more a real requirement now. And we're hearing this from so many customers. But when you started out, I mean, looking at obviously believing that collaboration is key in this area, if you want solutions that look at shipping, intermodal transport, mining, extraction, refining, all of those areas, this is a complex game. So where do you start, or where did you start with all of that?
Well, I think what's important is to understand what Visanda is trying to achieve. I mean, for us, we talked about disclosure topics, we talked about ESG. I am of the idea that ESG, we can challenge ESG somewhat, because a lot of it comes from financial reporting, income statements and balance sheets. However, we wanted to actually have a real tangible ESG score in what we do. So we decided to look at specific industries and specific areas of finance, such as commodity trading, trade finance, structured trade finance, and so on. So what we wanted to do is really kind of follow the transaction's life cycle throughout, from the origin to destination. And in order to do that, there's a number of things that need to go into that. It's not only big data that we are consuming, synthesizing, and extrapolating data from, but you're also adopting satellite infrared technology. You're adopting big data, machine learning, and AI. You're also, and of course we're a Polestar Group company, so we rely on you guys for the best in class in maritime intelligence. So just combining all of that, and then taking a step further by working with all of the certifying groups and NGOs around the multi-stakeholder groups and value chains of certain commodities to understand the social aspect of that transaction. And the governance really comes from the counterparties and how we measure their sanction screening, whether it's for the charter or the vessel, and the organization sort of controversy levels.
I mean, the challenge with all of these things, I think, going forward is obviously making this streamlined, automated, auditable, recordable. And it's such a complex kind of area. The combination, we think, obviously, of the E and the S and the G, the three collaborating partners in what we're putting together here is fundamentally vital. But can you talk us quickly through the kind of four pillars that you've identified in the market, i.e. how you can simplify this process for an institution or a company?
I think for us, the key is to understand the main areas of a sort of a transaction in trade. You will have the environmental impact of that transaction. So you will be looking at and monitoring for things like deforestation and soil erosion as sort of high-level factors in assessing the biodiversity around some of the production processes for either commodities or the farming. So we look at these things as very important, as well as the carbon emissions from the entire transaction. What does that look like? The cultivation, the processing, the mill, putting all of that together is a really powerful combination. And then the social, as I explained earlier, that for us is very important because, when you're working with certifiers and you're working with NGOs and multi-stakeholder, organizations, what you're doing is you have boots on the ground who are giving you information through the lens of the cultural value system of that country. So you're not really, to put it colloquially, not looking at the world from a Western perspective all the time and try to analyze the social justice from say the European perspective. We have to be mindful of how these things stack up for them in the global South and how it differentiates from the global North. So that's a really a very big portion for us because we find that S often is neglected, and there is a correlation between E and S, where deforestation or degradation of biodiversity can impact villages and populations, and of course that is a real human experience that we are looking at. And of course everything else inside the transaction, whether it's the counterparties, the risks associated with the counterparties, the vessel, the transportation, the choice of mills you're using, etc. This is all forms part of the governance, and we don't literally have to look at what your board looks like or what it's made up of, because we're looking on a transactional level. And so if you are going to ask me what are the 4 pillars or 3-4 pillars that are, the E, the environmental, not really looking at environment, not with a tunnel vision on carbon only, because I think, we sometimes forget that, yes, you have a vessel and there's the carbon emissions from the vessel, but also you are also emitting carbon by digging up sort of land and cutting trees down and releasing carbon stores from peatlands, etc. So it's very important that each letter is sort of analyzed and given its respect in its own entirety.
Well, given we're going through the E and the S and the G, Hannah, going beyond the E and ESG, can I hand back to you?
Yeah, absolutely. So in terms of going beyond on the E, we've so far at the LMA, we've been working with our members in terms of sustainable finance and the finance products that are developing around the E, the S and the G. So back in 2018, we developed the Green Loan Principles, which were a set of principles which were basically a high-level framework of market standards and guidelines for structuring green loan products. And green loan products are aimed at providing funds specifically for green projects, so things like renewables. So that very much focuses on the E. But then we were asked if we could help with the development of some similar principles around sustainability linked loans, and they're a different type of product because they look at improving the borrower's sustainability profile rather than where the funds are directed to. And I think this goes to the really important point of everyone is on a journey in terms of ESG, and not everyone is at that sort of dark green end of the spectrum. So we need to move industries along in terms of sustainability, and one way to do that is to incentivize borrowers to actually improve their sustainability profile. So we developed the sustainability linked loan principles alongside our members to try and make sure and encourage every part of the market to actually become more sustainable. And that means not just in terms of environmental sustainability, but also social sustainability as well. So we've seen loans with targets linked to gender targets, for example, and a whole broad range of ESG targets in relation to sustainability linked loans emerging, and really helping to move borrowers to becoming more sustainable. And sort of the natural progression then, we're seeing the moving focus onto the S in ESG as well, and for companies to help towards achieving positive social outcomes. So we have recently developed the social loan principles, which are a set of principles for loan products that are specifically used to fund social projects. And so there's that sort of movement towards focus on the S as well. But one thing that I think we were asked to do in developing these principles alongside our members was to provide a robust framework of standards to try and make sure that these products had a framework that the market could look to provide integrity for these products, and to ensure that they weren't sort of seen as being social washing or greenwashing, because they have this inbuilt robust framework around review and reporting, and making sure that there's transparency in terms of use of proceeds, particularly around the green loan principles and the social loan principles. So that there is that, as we've discussed, that need to focus on social as well as environmental issues, and now I think we've got a sort of spectrum of social finance products that are available to lenders to assist right across the loan market in terms of providing the necessary finance.
Great, thanks for that, Hannah. Phil, you were up in Scotland at COP26, so I didn't get to watch all of it. I don't think anyone did, but what were some of the key takeaways? Were there some key or really strategic points that you took back on the train back to London with you?
I think there were a lot of discussions, a lot of interesting discussions, and some of the key takeaways for me were, of course, Article 6 of the Paris Accord. That's a contentious subject. There doesn't seem to be any sort of agreement on what carbon credit trading is going to look like, and how we can overcome this issue with double accounting, meaning, where are you offsetting? Are you offsetting at the origin? Are you offsetting at the source, and so on? And of course, as part of that, there is the old style carbon credits, which a lot of countries have a surplus. And now we are talking about a new system being introduced, and can we reuse the old style sort of carbon credits? So there's a lot of detail to discuss there. And I don't think we have arrived at a real answer in terms of what's going to happen there. I think the other two very important things is reducing or completely removing coal from production, which is in itself is controversial, as you know, because some countries still rely on coal, and its production is highly environmentally adverse. So there are not just ecosystems in terms of the social inequality of removing that industry overnight, but also economies that rely on this, and you cannot just brush it with a green brush and remove it today, because I think we need to carefully think and strategically think about its replacement.
Absolutely.
I think those are the two very important things. But for me specifically, what resonated is the Deforestation Pact and the number of countries that signed up to it, and the countries that didn't sign up to it. And those who didn't sign up, and we were not going to mention any countries. I'm sure you could do your due diligence, but some of those are known to have higher levels of deforestation. So it is a question of commitment, and how committed are those countries to these sustainability goals.
And Hannah?
Yeah, so I think there's still a lot to iron out in terms of detail, and everything is moving extremely quickly at the moment. We saw the huge number of announcements that came out around COP26 around ESG and ESG regulation. So I think there is a long way to go, but as I say, I think we're seeing that more of obviously we've got a lot of focus on environmental and climate change, but I think we are following in particular the COVID-19 pandemic, we're seeing more focus on social as well, so there's that broader picture. And it's going to be a really interesting period following this huge amount of interest that we've had in ESG, just to see how the market kind of consolidates around ESG and how market practice continues to develop, as well as regulation.
Great, thank you, Hannah. I guess from my part, I think the transition has already begun. We see, albeit voluntary, we see many major institutions really pushing and driving these agendas now, in terms of sustainable trade financing, monitoring of these end-to-end programs of work and transactions. So I guess the race is on. The deadlines and dates have been set, but thank you both for your input today. And to Jeff, the team at GTR, thanks for having us and hosting today.